Welcome to the Deep Dive. Today, we're diving straight into HDFC Life Insurance Company, specifically their new results for the financial year 2024-25.
That's right. We've got the press release, the investor presentation, the board meeting outcomes,
Yeah.
the whole package.
And our mission really is to sift through all this dense material.
Exactly. We want to pull out the key insights for you, the listener, so you can get a quick handle on their performance, their strategies, basically what matters, without reading, pages and pages of report.
Think of it as your shortcut, because there's a lot in here. High-level growth, customer stuff, future plans.
It's all there.
Okay, let's unpack this, starting with the big picture, the overall financials.
Sounds good. The press release itself kicks off with this theme of sustained performance and consistent delivery.
Right. And do the numbers actually reflect that?
I'd say so. First off, 18% growth in individual annualized premium equivalent, or APE.
Okay, APE. Just quickly, that's basically a measure of new policy premiums collected, right? Kind of standardized.
Precisely. It annualizes single premiums and counts regular premiums. So yeah, 18% growth there is a strong signal. More new business coming in.
And is it profitable business? That's always the question.
Seems like it. The value of new business, VNB, that grew by 13%. It hit 3,962 crore.
VNB. That's like the expected future profit from this year's new sales.
You got it. It's a key profitability indicator. Yeah. So 13% growth suggests they're writing good, valuable business, not just chasing volume.
Makes sense. And this is helping their market position.
Looks like it. Their overall market share is up 70 basis points.
70 basis points. Can you put that into perspective? How big a deal is that?
Well, a basis point is 0.01%, so 0.7% increase. It might not sound massive on its own,
right?
But in a competitive insurance market like India, gaining almost a full percentage point of the total pie is actually quite significant. Shows they're gaining traction.
Okay, got it. And what about within the private sector against their direct competitors?
Even better there. Their private sector share hit 15.7%. That's up 30 basis points. So they're definitely gaining ground specifically against other private insureds.
Okay, let's talk scale. Assets under management, AUM, that number is usually huge.
It is. Grew 15% year on year. Reached, let me check the figure, 3,036,282 lakh crore as of March end 2025.
Wow. That's a lot of assets they're managing.
Absolutely. And it's not just about bringing new money in. Keeping existing customers is crucial, too. Their persistency rates look strong.
Persistency. How many customers stick around?
Exactly. 13th month persistency is 87%. Pretty good. But the really striking one is the 61st month. That's 5 years out.
Right.
It jumped by 1,000 basis points, up to 63%.
1,000 basis points. That's a 10 percentage point jump, isn't it?
It is a really significant improvement in long-term customer retention. The press release calls it deep customer engagement and effective retention initiatives.
So it might be behind that. Better service?
Yeah.
Specific products?
Probably a mix of things, better communication, maybe loyalty benefits, making the long-term experience smoother. It's really valuable for an insurer, means more predictable income.
Okay. That idea of long-term value seems important. What about embedded value, EV? How's that looking?
Also strong growth there, up 17% to 55,423 crore.
And embedded value, that's kind of the total underlying worth of the business, right? Future profits from existing policies plus current net assets.
That's a good way to put it. It's a core valuation metric, and their operating return on that EV is 16.7%. So they're generating good returns on that underlying value, which shareholders like to see.
Right. Sustained long-term value creation, as they say.
Exactly.
And this all flows down to the bottom line, the profit.
It does. Profit after tax, PAT, was 1,802 crore for the year. That's up 15%. And interestingly, a big chunk of that comes from profit emerging from their older policies, their back book. That part grew 18%.
So profits aren't just from new sales, but also steadily coming from the policies they already manage.
Precisely. That profit emergence is key for insurers.
And anything for the investors directly. Dividends.
Yep. The board recommended a final dividend, 2.1 per share, totals about 452 crore. Standard practice to return some value.
And their financial health. Solvency.
Very strong. Solvency ratio is 194%. The minimum required is 150%, so they have a very comfortable cushion.
Okay, so mostly a really positive financial story. Any slight counterpoints? Anything that nudged the other way?
Just a couple of minor things to note. The total expense ratio ticked up slightly, from 19.4% to 19.8%.
Why might that be? Investing in growth.
Could be. Or just operational costs. Not a huge jump, but something they'll watch. Also, complaints per 10,000 policies went up a tiny bit. from 29 to 31.
Is that concerning? Or just noise from growing bigger?
Probably more the latter at this stage, given the small increase. But again, something you monitor. Ensure service quality keeps up with growth.
Right. Okay, so that's the financial health check. Now let's look under the hood. What strategies, what products, what channels are actually driving these numbers?
Good question. Let's start with the product mix, based on that individual APE figure.
Okay.
ULAPs, the unit-linked plans, they're the biggest chunk now at 39%. That's up from 35% last year.
Interesting. More market-linked products?
Seems so. Non-par savings are next at 32%, also up slightly from 30%. Annuity and protection are both steady at 5%.
And what's gone down?
The traditional participating policies, the par products, they've dropped from 23% of ATE down to 19%.
So definitely a shift towards ULAPs and non-par savings, away from traditional par. Why do you think that's happening? Customer demand. Strategy.
Likely both. ULAPs offer market upside potential, which might be attractive, and non-par savings offer guarantees, which some customers prefer. It could reflect HDFC life, focusing on these segments, or just changing customer preferences, maybe a bit less appetite for the opacity of traditional par products sometimes.
Okay. And how are they selling these? The distribution channels.
Corporate agents are still dominant. That's 65% of individual APE, same as last year.
And that's mainly the HDFC bank partnership, right? Bank assurance.
Yes. HDFC Bank is the lion's share of that corporate agent channel. Still, around 65% of overall APE comes through the bank partnership. It's hugely important.
Still. Okay, what about other channels?
Agency, their own agent force, is steady at 18%. Brokers are up slightly to 7%. And direct channels, like online sales, are down a bit to 10%.
So the bank channel remains critical, but the mix otherwise is relatively stable.
Broadly, yes, though we'll touch on how they're trying to diversify that distribution later.
Okay. The presentation also shows some nice trend charts over the years, right? Consistent growth.
Yeah, they really emphasize that. Individual APE, for instance. Back in FY17, it was 9.2 billion rupees. FY25, it's 39.6 billion. Steady climb.
And value of new business.
Similar story, though there was a big jump around FY23. They note the budget changes then likely boosted demand for certain products, but overall, a clear upward trend in VNB too.
And you mentioned persistency earlier. That initial 13th month rate has also been solid over time.
Very consistent. 81% back in FY17, 85% in FY21, now 87% in FY25. So they're good at holding on to customers in that crucial first year.
And the embedded value growth we talked about, that's also been a long-term trend.
Absolutely. From 108 billion rupees in March 2017 to 377 billion now. That highlights the long-term value buildup.
Okay, so what are the strategic pillars holding all this up? What are they trying to do?
They lay out 5 key areas. Profitable growth, that's obvious. Diversified distribution mix, customer first, risk management and governance, and technology, digital and analytics.
Let's dig into that diversified distribution. We know HDFC Bank is huge, but what else are they really broadening out?
They're definitely trying. They highlighted adding over 40 new banca partnerships just in FY25.
40? Wow.
Yeah, bringing the total distribution partnerships to over 300. This includes tie-ups with NBFCs, small finance banks, brokers, other kinds of partners.
So actively reducing reliance on just the one big bank partner?
That seems to be the goal. And their own channels are growing too. They have about 2.4 lakh agents now. And that agency channel has seen decent APE growth itself over the last few years.
Makes sense. What about product focus? They mentioned healthy growth in protection. Is that a strategic push?
I think so. Protection products, like term life, are fundamental. Good for customers, generally good margins for the insurer. Their retail protection APE hit 7.4 billion rupees in FY25. That's a 26% compound growth rate over 2 years.
Pretty strong.
Yeah, and the total sum assured, the actual amount of cover, grew even faster. Plus, they launched 3 new protection products last year, so definite focus there.
Okay. And the customer first pillar. What does that mean in practice?
It's about using tech, personalization, simplifying things, making the whole experience smoother. They mentioned ranking #1 in a big industry customer experience study by Kantar.
That's a good validation.
It suggests their efforts are paying off from the customer's perspective.
And the governance side, risk management.
Standard but crucial stuff. They talk about having robust frameworks, various board committees overseeing everything from audits to investments to protecting policyholders, foundational for trust and stability.
Right. The plumbing needs to be solid.
Exactly.
And the final pillar, technology, digital analytics, being future ready. What are they doing there?
This sounds like a big push. They mentioned something called Project Inspire, aiming to build a next-gen insurance platform.
Sounds ambitious.
It does. And they're also using AI, specifically Gen AI, things like a complaint predictor, a calls analyzer to understand customer interactions better, even a pre-claims assistant, using tech for efficiency and insights.
So definitely investing in tech to streamline and improve things.
Seems core to their strategy moving forward.
Okay. Anything else on their other businesses? Pensions. International.
Just quick updates. HDFC Pension Fund Management is apparently the largest private player growing its subscriber base. And their international unit in Gift City, HDFC International Life and Re, is showing positive operating performance.
Got it. Now, let's zoom out a bit. The presentation talks about the India growth opportunity. Why frame their results in that context?
Well, it sets the scene, reminds everyone of the potential. India is a fast-growing economy, fifth largest globally, big, expanding middle class. Projections show per capita GDP doubling, many more middle-income households emerging. All this means, theoretically, more people needing and affording financial products like insurance.
And the argument is that insurance is still underdeveloped in India.
Exactly. Compared to global benchmarks, life insurance penetration, whether you measure it against GDP or premium per person, is still relatively low.
So a big gap to fill.
A huge gap, and specifically, life protection levels are very low. Plus, the retirement savings market is also seen as underpenetrated, but set for major growth. It paints a picture of a massive potential market for companies like HDFC Life.
And they position themselves as helping fill that gap, contributing to nation building.
Yes, they frame it that way, mobilizing long-term savings, ensuring more people. They also point out that private players, like them, are taking a growing share of the new business in the industry.
Okay, so the macro environment looks favorable for growth.
Yeah.
Let's circle back to a technical but important metric. Embedded value. Why is it so central?
Right, IEV, as they call it, Indian Embedded Value. It's really a cornerstone for valuing life insurers. It tries to capture the total value belonging to shareholders.
More than just book value.
Much more. It includes the current net worth, but crucially, it adds the present value of expected future profits from all the policies currently in force. So it's forward-looking.
And that total IEV figure was 55,000 crore.
55,423 crore as of March 31st, 2025, yes.
How does that break down? What are the components?
Two main parts. First, the adjusted net worth, which is about 16,283 crore. That itself includes their free surplus capital they could potentially distribute and required capital what they need to hold for regulatory reasons.
Okay. And the second part?
That's the value of in-force business, the VIF. That's the bigger piece, at 39,140 crore. That's the present value of those expected future profits from existing policies.
Right. And they also separately show the value of new business, the VONB.
Yes, that euro 3,962 crore figure we discussed earlier, that's the value added just from the policies sold this year.
The report also mentions sensitivity analysis on the EV. What's that about?
It's about transparency and risk. They show how the EV number might change if key assumptions shift, like interest rates or stock market returns.
So, stress testing the valuation.
In a way, yes. For example, they state that if interest rates went up by 1%, the EV would likely decrease by about 2.7%. It gives a sense of how sensitive the valuation is to economic factors.
Important context. And this whole EV calculation isn't just done in-house, right?
No, and that's key. They state it's been independently reviewed by Milliman Advisors, a major actuarial firm. Milliman confirmed it follows the official standards, APS 10. That external validation adds a lot of credibility.
Definitely reassuring.
Okay.
Okay, almost there. Let's just cover the final bits, regulatory and other information. Anything major stand out?
Well, we already mentioned the dividend recommendation, 2.90 per share. The record date is June 20th, 2025, pending shareholder approval, of course.
The standard procedure. What else? Audits?
Clean audits. The joint statutory auditors gave unmodified opinions on the financials. That's the best outcome, means no major issues found.
Any legal or tax things?
They did mention receiving some GST demand orders. Seems like they're appealing those, so that's an ongoing process.
Okay. And customer complaints?
Very low number of unresolved investor complaints reported as of March end. Just one for the main company, 0 for the consolidated group. Seems well managed.
And they raised some capital, too.
Yes, they issued some non-convertible debentures, NCDs, about 1,000 lakh worth. Just another way they manage their capital structure.
Okay. Wow, we've covered a lot of ground. Let's try and synthesize this for everyone listening. What are the main takeaways from this deep dive into HDFC Life's year?
I think the headline is clearly strong, consistent performance in FY25. You see it in the new business growth, the APE and VNB figures.
Right. And crucially, that improved customer retention, especially the long-term persistency jump. That felt significant.
Absolutely. Plus, there's a clear strategic direction, focusing on diversifying distribution, really pushing the digital and tech angle while keeping an eye on profitable growth and protection.
And all this positions them pretty well, doesn't it?
Yeah.
Given that wider context of the Indian insurance market still having so much room to grow.
Definitely. They seem well placed to capitalize on those opportunities.
So the big so what question then? What does all this signal for HDFC Life's future? And maybe for the insurance sector in India more broadly?
It really leads to a final thought, doesn't it? As financial literacy grows in India and people increasingly recognize the need for both protection and retirement savings, well, how might a company like HDFC Life, with its focus on the customer and product innovation, actually shape that future?
How might it impact the financial security landscape for individuals? Yeah, maybe even for you, the listener. Yeah. Something to mull over regarding your own plans, perhaps.
Exactly. Food for thought.